Welcome back, dear traders. Wall Street was overwhelmed by the doom and gloom in the light of Powell's congressional testimonies. On the one hand, investors are trying to reconcile with the rate hike by 50 basis points. On the other hand, they are desperately searching for the signs that the US economy is easing its growth and the labor market is cooling down. Today, investors have found the long-awaited glimmer of hope. Yesterday, market participants digested the confusion message in Powell's speech and the mixed economic data. As a result, the benchmark indexes waved between gains and dips and closed mixed. The Dow Jones shed 58 points, or 0.18%. The Nasdaq added 0.4%, and the S&P 500 grew by a modest 0.14% to close at 3,992 points. The major stock indexes traded in the red in the New York pre-market, but they reversed up in the early trading hours. The S&P 500 is expected to trade in the intraday corridor between 3,960 and 4,040 points. In the second speech of Capitol Hill, Jerome Powell confirmed his message about the prospects of a faster pace of further rate hikes. Still, he warned that the next policy decision would depend on the totality of economic data that would be released before the Fed's meeting in March. The data published on Wednesday didn't dispel worries about higher interest rates because the ADP employment report revealed stronger than expected jobs growth in the U.S. private sector in February. In the JOLTS job openings, the number of vacancies went down less than expected, and the figure for the last month was upgraded. This proves tough employment conditions. The non-farm payrolls and the inflation report will provide the key to the size of the next rate hike, 25 or 50 basis points. Meanwhile, traders are increasing their bets on a rate hike by a half of a percentage point in March. Fed funds futures now show an 80% chance of this scenario compared to 70% recorded on Tuesday and 31% on Monday. Among 11 sectors in the S&P 500, 7 sectors closed in the green. The energy stocks dropped by 1%, being the weakest sector due to the falling oil prices. The real estate sector logged the strongest performance, with the stocks closed 1.3% up. Tesla shares fell by 3% because the U.S. car safety watchdog was launching an investigation into 120,000 Model Y cars. After reports on steering wheels completely detaching while driving, accidental petroleum shares rose by 2% after Berkshire Hathaway, run by Warren Buffett, expanded its stake in the oil company to almost 22.2%. Futures on Wall Street indexes went down intraday on the back of the strong labor market and remarks by Jerome Powell. However, the market got a second win in the light of a weekly update on the U.S. unemployment claims. The number of first-time jobless claims has been declined for 4 weeks in a row. The figure has been firmly stuck below 200,000 for 7 weeks straight. The trend is eventually over. The number of initial unemployment claims grew by 21,000 to 211,000 last week, whereas the consensus was 195,000. The reading was the first surprise in the last months, indicating that the labor market is getting less tense. Now, market participants are anticipating the non-farm payrolls, which are due to tomorrow on Friday. The U.S. economy is expected to add 105,000 jobs last month, following a sharp employment growth of 517,000 in January. Today, the US stock market could take a break and halt its rally. As for corporate news, JP Morgan Chase has sued former executive Jess Staley, the ex-Barclays boss, over his links to Jeffrey Epstein. Jens Staley was accused of sex trafficking. Shares of a crypto lender Silvergate that went bankrupt slumped by 45% in the pre-market because the company intends to withstand from a business. The stock of high-tech giants such as Microsoft, Apple, and Amazon regained early losses and rebounded by 0.2 and 0.6%. The US dollar, loosening its grip against major currencies, its index retreated from a 3 months high hit yesterday and dipped to 105.50. Later on, it slid to 105.30. The intraday carrier for the instrument is seen between 104.90 and 105.70. The G10 currencies were leaking rounds for the whole on Wednesday and were regaining their footing against the US dollar. Nevertheless, the US dollar index is still not far away from a 3 months high. The medium-term outlook for the greenback remains bullish, thanks to the hawkish Federal Reserve and the healthy labor market. Powell admitted that the policy decision in March would depend on incoming data. Recent macroeconomic data set the stage for the US dollar's advance across the board. Global investors are betting on a rate hike by 50 basis points at the end of March. With such prospects, they are looking forward to the official employment data, which could set the market in motion. Meanwhile, the US dollar is halting its rally while stock investors are enjoying the long-awaited growth in weekly jobless claims. The Canadian dollar is extending its weakness despite a minor rebound in the pre-market. The USD card pair is consolidating at around 1.3799, within the intraday corridor between 1.3760 and 1.3840. The Bank of Canada decided to put interest rates on hold on Wednesday. Traders responded instantly, and the loonie weakened to a 4 months low at 1.3815. The overnight target rate was left unchanged at 4.50%, so the Bank of Canada is the first influential central bank to halt its tightening campaign. The weaker currency could increase the value of imports for Canadians, thus escalating inflationary pressure. The Canadian economy is more sensitive to interest rates due to the overheated housing market. The market expects the Bank of Canada's interest rate to top out at 4.75% this year, which is roughly 90 points lower than the ultimate size of the Fed's funds rate. Interest rates in Canada have been lower than the Fed's rates during 3 tightening cycles since the early 2000s. The gap was from 50 to 75 basis points. The medium-term outlook for the loonie is very gloomy. If the Federal Reserve raises interest rates by 50 basis points, which is the most realistic scenario, the loonie is set to weaken further. Now, traders are cautious ahead of the non-farm payrolls publication. Oil prices are trading flat intraday, so the Canadian dollar is going to trade quietly and even recover a bit. The crypto market is hurt by malaise. Crypto assets are heading for old lows. Bitcoin is extending a decline today, having lost 1.7% intraday. The token is now trading at $21,618. Ethereum approached $1,500. Solana, Litecoin shed 0.2 and 0.7% respectively. Ripple rebounded by 0.3%. Still, the crypto market is trying to stay afloat despite bad industry news. Apart from the hawkish Federal Reserve, market sentiment is dented by the saga with the crypto lender Silvergate. Silvergate Capital unveiled its plans for terminating operations and declaring bankruptcy. The shares nosedive by another 45% on the next day after they had plummeted by 64%. The shares of a Signature Bank running off the blockchain technology dropped by 9%. The shares of the crypto platform Coinbase that broke its relations with the bank last week fell by 3%. Mining companies Ride Blockchain and Marathon Digital tumbled by 3.5% and 4% respectively. Bitcoin stabilized at about 21,647, the lowest level since mid-February. The token is running the risk of sinking below 20,000 for the first time in 2 months. Notably, the firm US dollar makes Bitcoin and other cryptocurrencies more expensive for investors. Holding other cryptocurrencies, in turn, this reduces demand. Technically, Bitcoin is now finding support at about 21,550. Once broken, the price could either rebound to $22,850 or decline lower. Trade prudently with the InstaForex and see you online tomorrow.